welcome to Lazy Trader Core Essential Risk Management. Now this module is absolutely crucial for your development as a trader, and we'll start from the ground up. Risk management is the cornerstone to your success, and in this module we'll discuss risk management essentials, how to protect your trades, trade sizing fundamentals, how to beat the broker at his own game, stop loss management, how to emulate the profitable pros. We'll also bulldoze a few myths for you and teach you exactly what you need to know to grow your account steadily and safely. We'll also explain reward to risk ratios, how to identify high reward trades, which is the name of the game, and we'll show you a few pitfalls where 90% of people who trade the markets fall into, but how you can avoid them. So risk management is exactly what it says on the tin. You're managing your risk, and as managers of your account, you should treat this as a business with low overheads as well. And as you've probably heard the old adage, you should never trade with more money than you can afford to lose. Obviously, trading has its risks, but with risk management, we can minimize these risks. So as I said about treating trading like a business, we want to give ourselves the best chances of success when doing so. And of course, as traders, our key ulterior motive might be to make money, but before we do that, we want to obviously assess the risks to us and minimize the downside. And whilst you'll learn on the program that we want our winning trades and we want to leave them to run and obviously hit our targets and gain us more percentage return, we want a mechanism whereby we can cut our losing trades to a minimum. And in order to cut our losing trades to a minimum, we need to essentially control or limit how much of our account is at risk on any one trade at one time. And this is where a lot of people go wrong. They don't know about risk management, they don't know about trade sizing, and they sure as hell do not know that the broker gives them the opportunity to get out of a trade if things start to go pear-shaped. And sure enough, this explains why 92% of people who have a go at trading fail in a spectacular fashion. We don't want you to be one of them. In fact, we want you to be in the 8% of people who prevail and get a consistent income and capital growth from trading. So one of our key staples to our success is the rule: you should never risk more than 1% of your account per trade. Certainly if you're consistent, we can say risk no more than 2%, but whilst you're starting out, risk no more than 1%. It will keep you in the game for longer, whilst controlling the amount of money lost if you do have a losing trade. And certainly if we do have losing trades, we can accept them as being a necessary evil in pursuit of a string of wins. Opportunities in the market are like buses, they can all happen at the same time, and that can be said also about winning trades. They can all happen at the same time. It's called variance. You might have 4 wins and 2 losses, and then you might have 5 losses and 3 wins. But as long as the reward on the winning trades is bigger than the losses you sustain on the losing trades, then you know you can consistently move forward making money from the net sum of your trades in total. So you might have heard the old adage, to create is effort, to copy is genius. And that's very much the case in trading. Why would we want to try and reinvent the wheel? A wheel which has been well lubricated and is turning very well indeed at a good speed. So whilst we've also scratched the surface as to why 92% of the people who try at trading fail, we want to emulate the top 8% of traders who are actually doing it and consistently profitable. And we want to copy what they do and how they do it. There's absolutely no room in trading for people who are new to the profession who try and be smart and reinvent things or try to tested formulas that are already working. It's absolutely pointless. Certainly curiosity got the cat, but the cat has only got 9 lives. And we can essentially hone the core attributes in being a successful trader on being down quite literally to these 3 skill sets: having the right strategy, the right mindset, and absolutely most crucially, the right risk management tools. At the very worst, at least with managing risk, you are in the game for longer. So what do the 92% of people who fail tend to do? Well, they gamble, they have absolutely no trading plan whatsoever, They place a very high frequency of trades with pure blind faith. They risk too much per trade, and they have absolutely no respect for the utter chaotic randomness of the market. Compare this to the 8% who quietly make their money on a consistent basis. They have a trading plan. They treat trading just like a business with a profit and loss account. They have respect for the market. They have rigid risk management parameters, and they only trade when all their rules are met. So if you cast your mind back, we just mentioned never risk more than 1% per trade. So if you've got a trading account of £100, don't risk more than £100 per trade. If you've got a £10,000 account, or dollars for that matter, don't risk more than £100 or dollars on that trade. If you're fortunate enough to start up with £100,000, don't risk more than £1,000 per trade. It's that simple. 1%. And we want to use this 1% in the following formula. It's 1% of your trading account. Say, for example, you started off with £10,000. So that's £100 divided by the difference between your entry price and your stop loss. That will give you a figure, which is how much you should place with your broker per pip. This is what we call a stake size. So, for example, if we've got £500 risked here, which is 1% of a £50,000 account, and our entry is 9483, and our stop loss is at 9392, we have a difference of 91 pips between our entry and our stop loss. So what we do is we divide 500 by 91. And that figure gives us £5.49, and that's our stake size. We shouldn't be risking more than £5.49 per pip if we only wanted to stay within our 1% risk per trade parameters. Any more, that would be breaking those rules, and we do not want to be doing that so prematurely into our trading journey. Our second staple for success is always use a stop loss. No matter how big or how small your trading account is, we are money managers, essentially looking to profit from opportunity, and as any entrepreneur would do, they would also consider the downside to any potential business decision and the risk presented to them. So we want to do the same and consider the downside and risk presented to us whenever we place a trade. So we use a protective stop loss, which is a special order which brokers should give you. If they don't give you that option, then you might want to consider changing brokers, because most brokers do, and it's absolutely essential if you want to stay in the game. This stop loss will get you out of a trade. If price action goes against you, hits the stop, it will automatically get you out of the trade, and you'll sustain a loss, but the loss will be no more than the money you've basically placed on the trade, i.e. 1%. People who do not do this run the risk of wiping out their entire trading account. And who wants to do that? So just to clarify, a stop loss is the level specified to the broker by the trader, and they will automatically exit you from the trade if the market decides to turn the other way. This is absolutely crucial. This is as crucial as essentially risking the right amount per trade. And this is something that 92% of people who trade the markets and fail, they don't get this. This is not even a part of their plan. They just whimsically have a go at trading and fail in a spectacular fashion. We don't want to be like them. We want to copy the profitable pros. So with the combination of the 1% risk per trade rule and the requirement of having to use a stop loss, you'll see for yourself how little maths is actually involved in trading. Contrary to popular myth, there's this romanticized image of a good trader happening to be also a mathematician of sorts, but that's not the case. You saw how easy it is to work out what 1% of your trading account is, and a simple subtraction, that's as difficult as it gets. And we'd like to prove this to you in examples a little bit later on. And if you start off with a small trading account, for example, you start off with, say, £1,000 or $1,000, and percentage-wise, you're making a great percent. Say you made £100 on your £1,000 trading account, which doesn't seem like a lot in monetary value. However, in percentage terms, 10% is a fantastic return, which trounces what the banks give you, certainly better than most dividend-yielding stocks at the moment. So look at your gains in trading in a percentage term. Do not look at it in monetary value. Certainly, if you haven't got the means necessary to fund your account when you're consistent by hundreds of thousands, the money will come to you. Believe you me. Don't go trying to risk 5% just because you want the extra bit of money from it, because the market will punish you for this. And if you're making 10%, even if it's in a year, 10% on like a £1,000 account, that certainly trounces in percentage terms any other instrument out there at the moment, at the time of doing this. So let's take pound dollar, affectionately known as cable. In this example, we've got an entry at 16093, just above the high of this low test bar. We'll discuss low test bars a little bit later on into the program. And we've got a stop loss at 15972. We've got a difference of 121 pips between our entry and our stop loss, and we've got a £5,000 account. So, with our 1% per trade risk, we don't want to risk any more than £50. So we divide that 1%, £50, by 121 pips to give us 41 pence per pip. So when we come to place a trade with our broker, we do not want to be placing any more than 41 pence per pip. That is crucial, and that is trade sizing, sticking within our 1% rule. We're also taking note of the fact that we're using a stop loss here in tandem with our entry. Let's look at dollar CAD, also known as the loonie. If we're looking to sell here, and we're selling off this trend line and this horizontal level and this doji bar, which is again something we'll discuss later on, we've got our entry at 9958 and our stop loss just above the high at 162, giving us a difference of 104 pips between our entry and our stop loss. So we have a £150,000 account here. Sticking within our 1% rules, we don't want to risk any more than 1,500. So what we do is we divide 1% of our account, 1,500, by our 104 pips to give us £14.42 per pip. We do not want to risk any more than £14.42 per pip in this trade, sticking to our 1% rule. Let's take CAD Swiss, this cross-currency pair here. We've got a £1,000 account, and we've got an entry long on this small inside bar here at 94.48, just above the high, and our stop loss is just below the low at 93.64, giving us a difference of 84 pips between entry and stop loss. So, as 1% of £1,000, our account size is £10, we divide £10 by 84 pips, giving us 11 pence per pip. We don't want to trade any more than 11 pence per pip. Let's take a look at pound yen, also known as the twisted sister, and our £10,000 account here. We're looking to sell off this high test bar, off this level at 140 or 1400. Our entry is just below the low of the low at 1384, and our stop loss is just above the high at 1400, giving us a difference of 165 pips between our entry and our stop loss. We risk 1% of our account, which is £100, by the difference between our entry and our stop loss, giving us 60 pence per pip. We don't want to risk any more than that for our stake size with our broker. So whilst we've discussed risk and the risk associated with any given trade and what you should risk per trade, we'll also talk about reward and how much you could potentially make per trade. Whilst we say only risk 1%, there's absolutely no limit to how much you could potentially make. And this is what we're going to discuss in further detail. Certainly the reward element of risk reward is our lifeblood. And we like to take the higher reward risk trade as many times as the market actually gives it to us. But the market is random. As we said earlier, opportunities in the market are like buses in London. They can either arrive all at the same time, or you might be waiting for a while. But when we say a reward risk of a 3 to 1, for example, that essentially means that we're looking to potentially gain 3% from our trade, risking our 1%. If we've got a 5 to 1 trade, it means that we're potentially looking to make 5% for every 1% we have risked. And certainly on our chosen time frame, the daily, we can go for the very high risk-reward trades as and when the market gives them to us. This is not possible on the smaller time frames necessarily. And at Lazy Trader, we've got a minimum of a 3-to-1 reward to risk threshold, so we don't go for anything less, which could potentially give us 3%. Sometimes we can even go for 20-to-1s, or 10-to-1s, 5-to-1s. Having a cap on our wins, we don't want to do that. We want to let our winners run, but we certainly need to have a cap on our losing trades. That's very important. And certainly, those of you who might be trading already in any given style, who are pretty new to this swing daily trading style of trading, will notice that we get more from placing fewer trades. And we take advantage of a sample of trades over the long term, over the course of a quarter, or even half year, up to a year, to give us our net result, rather than saying, oh, I've hit my daily target today. Because guess what? People who have a daily target of, say, 1%, more often than not, don't hit their daily target. And we're looking to simply trade in order to make long-term capital growth via using trading as a mere vehicle, rather than just simply telling everyone that we're traders just to simply impress our friends. Mind you, you'll be amazed at how many people actually do that, like I've written. So having a good reward to risk trade is one thing, but having it over the realms of possibility is another thing. We need to obviously go for what is likely to happen and what is a high probability outcome, looking at the chart rather than thinking, okay, well, I'm risking 1%, I would love to get 10% out of this, even if there isn't a chance in hell that it's going to hit your target. So we want to do what is probable rather than impossible and identify the most amount of criteria as possible that is in favor of our trade. And of course, sometimes people certainly who are new to trading would potentially experience that the more you look at the chart, sometimes conjecture seems to manifest itself over and above what is realistically possible. And there is this trade-off in trading. What kind of a trader are you? Are you somebody who'd rather go for high reward with lower probability, or are you somebody who'd rather go for lower reward and higher probability? It's a real trade-off, like we can see on this curve here, and certainly we can't answer this question for you. However, what we want to do is we want to go for high reward and relatively high probability, and getting the best of both worlds through trade management, and obviously banking our profits along the way whilst keeping ourselves in the trade. Certainly our 3-to-1 reward to risk minimum threshold gives us the best of both worlds, because not only do we have a decent reward risk, or risk reward, you also have a high probability of the trades coming through and hitting target. So, if we've got a reward risk criteria, the minimum of a 3-to-1, it also puts us under less pressure to take trades just for the sake of hitting an arbitrary monthly target. But here's the formula if you want to work out your reward to risk. We've got entry price, take away target price, over entry price, take away stop price. So if we look at this example here, if we've got an entry of 97.53 and our target price of 95.75, giving us a difference of 178 pips, i.e. the distance between our entry price and our stop loss, which is 45 pips in this case. So 178 divided by 45 is 3.9. So if we've got a reward to risk of 3.9 to 1, if we've got, say, a £10,000 or a $10,000 account, we can hope to get £390 or dollars for every 1% we risked. So for every £100 or $100 we risked, we hope to get 390, providing our trades hits target. And that's how you can work out reward to risk and your reward to risk criteria. Let's look at some examples now and put this into practice. So here we've got a wonderful cross-currency pair. We've got the pound New Zealand, which is very much underrated, and we're trading this high test bar off a trend line and off the moving average. Some of you might know it as a pin bar reversal or an evening star, whatever, it's the same thing. And we've got a difference of 167 pips between our entry price and our stop loss. And we've forecasted the target down here at this trendline support. Our target is 575 pips away from our entry price. So lo and behold, we divide 575 pips by 167. And this gives us a pretty good reward to risk. In fact, it gives us a 3.4 to 1 reward to risk trade, which is fantastic. That's within our rules. In fact, it's even better than our minimum threshold, and that's fantastic. It looks like a high probability trade. We've got good reward to risk behind it. We can take it as far as our rules are concerned. So let's look at dollar CAD, affectionately known as the loonie. And we can see, again, we've got a test bar or a pin bar, whatever you like to call it here. The 100 moving average, we've got our entry at 97.12 and our stop loss at 97.98, giving us a difference of 86 pips between our entry and our stop loss. And as our target is the previous level of support down at 94.67, we've got a difference of 245 pips between our entry and our target here. So 245 divided by 86 gives us a 2.8 to 1 reward to risk trade. So if we have a £10,000 or $10,000 account and we're risking £100 in order to pursue a 2.8 to 1, we can reasonably say that, okay, if it hits target, then we will certainly get £280 or dollars, risking that £100 or dollars. So even though it's not a 3 to 1, it's a 2.8 to 1, certainly you would take it anyway. It's a decent, close enough reward to risk profile. Now euro dollar, and we've got a pin bar of this level of trendline support here. We've got a difference between entry and stop loss of 45 pips, and we've got a projected target here at this trendline resistance of 243 pips. So, no prize for guessing what we do now. We divide our potential gain in pips, 240 pips, by 45 pips, giving us the reward of 5.4 to 1, which is a fantastic reward to risk trade, and these are the ones we typically go for in a heartbeat, providing they meet our rules, of course. So here again, we've got CAD Swiss, and we've got a very decent, well-established channel here. Our entry, as you can see, is at 94.05, and our stop loss is at 93.67, giving us a difference of 38 pips between our entry and our stop loss. And our projected target is, funnily enough, at the top of the range here at 99.13. So whilst we've got 508 pips projected reward here, and only 38 pips between our entry and our stop loss, we could divide 508 by 38, giving us a reward to risk of 13.3 to 1, which is a fantastic reward to risk. And this is the kind of profile which we typically look to get, providing the market actually gives it to us. So just to summarize, as money managers of Your Account Limited.com Incorporated, we obviously want to profit for any opportunity that the market gives us, providing it meets our rules. But also we need to establish the downside and what the potential risks are to our money. Risk no more than 1% of your account per trade. Never, ever, ever fail to use a protective stop loss. If your broker does not offer one of them, ditch him or her as your broker and pick a new one. And only pick trades with a decent reward to risk profile which makes sense. At least, at the very least, a 2 to 1. We usually go for a 3 to 1s minimum, but at the very least a 2 to 1. So you're safe in the knowledge that the 1% of your account is at risk, but at least it's in pursuit of gaining more than what you'd potentially lose if the trade goes against you. If it hits your target, then fantastic, you made 2%. That's the best thing that could potentially happen. If it goes against you, then it's lost 1%, which is the worst possible thing that can happen.